Welcome to our Taking Stock video for the week ending the 15th of March, 2024. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. How are you, Matt? You must be pretty rapt that Carlton won another game yesterday.
Another nail biter, and we got the job done. So very happy, Ken, and good to be joining you again.
Likewise, Matt. But before we get started, just a quick yet important reminder. The information we provide today is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile, so any past performance figures shouldn't be relied upon as a guide for future performance. Well, Matt, it's been an interesting week for equities. On Monday, the All Ords Index, it dropped by about 1.8%, and it was spooked by the decline in the US markets last Friday as traders took some profits ahead of the US February inflation report. In addition, we had iron ore prices. They took a tumble in the back of softening demand. There was rising inventory and also weak construction activity, especially in China, where government crackdown on property debt has led to a squeeze on steel demand.
Yeah, it's been somewhat of a bizarre week, hasn't it, Ken? And sort of my reading of it was that the US markets totally shrugged off what was a hotter than expected US CPI prints for February, which showed prices rising by 0.4% on a month-on-month basis, with the annual headline inflation rate at 3.2%, which was above the market's expectations. And if we strip out volatile items like food and energy, core inflation is plateauing at a rate above the Fed's target, which is at 3.8% at the moment, with the Fed target rate being at 2%. So this is pointing to some real stickiness in those inflation data. And for the Federal Reserve, which is adamantly claimed to be data dependent on the future for monetary policy, these are not particularly smart or good data points that are welcoming for those that are expecting rate cuts towards the end of this year. So over the short term, there is still some momentum, and that appears to be what's driving equity prices higher for the time being. But the market is pricing in this soft landing scenario where inflation comes down without jeopardizing economic growth. And from the funds perspective, we're taking a far more realistic view on things and positioning our portfolio for an economic scenario that is not perfect for corporate earnings. The reality is here, inflation is not moving in the right direction any longer. Oil prices are creeping higher, and there is that tightness in labour markets, which is keeping pressure on wages. So this all means that interest rates will need to remain higher for longer. And given that equity markets are pricing in aggressive rate cuts, we think that there is this heightened risk for volatility ahead.
Yes, Matt, financial conditions, they appear extremely loose at the moment, and together with the euphoria across AI-related stocks and also the growth in ETFs, it's becoming a highly speculative environment, not just across those unprofitable stocks, but other asset classes like Bitcoin, which has surpassed its previous highs. So this environment is no better presented than from the chart on screen, which compares the average performance of each group of stocks based on their financial health. As you can see, the group of unprofitable stocks in distress, early warning and marginal, has outperformed those that are in strong financial health or satisfactory for the last month.
Well, if it's not Bitcoin, that's that pulse on where speculation is. It's that chart on screen there showing that the ugly companies are performing particularly well, and a handful of those stocks include BrainChip Holdings, APM Human Services, and Appen, which all rallied some 80% over February. And the problem for us is investors are drawn towards these type of businesses on the allure of short-term profits and momentum in the market, and everybody's getting a little bit greedy. But the reality is that insolvencies and the data attached to it is starting to increase. We can see here on the screen that the number of insolvencies on a month-on-month basis are starting to accelerate. This, for me, is the lag effect on monetary policy in motion.
Yeah, the risk of insolvency is certainly high, so it's important to invest in those quality, financially healthy businesses. Our style growth stocks, they've performed exceptionally well during the reporting season, Matt, generating an average return of 5.2%. And that's well above the market return for that month of 1.2%. And of course, it was due to our stringent stock selection process, selecting those high quality businesses, including Altium, WiseTech, RPM Global, Wesfarmers, Jumbo, and Netwealth, which all gained over 15% in February. But let's now turn our attention to some star stock highlights for the week. Last week, we did initiate coverage on Mader Group. The code's MAD, and the company provides specialized contract labor for maintenance of heavy mobile equipment in the resources and civil industries. Now, earnings are expected to grow by double digits, driven by greater mining and infrastructure spending, with growth avenues through geographic expansion to the US and also Canada. The company's largest cost base, obviously, is the employment of its qualified tradespeople that engage in contract labor and also other ancillary services.
It's also great to see, Ken, that Mader is founder-led, with Mr. Luke Mader serving as executive chairman, and Mr. Mader has a 57.4% stake within the business.
Yeah, that's quite positive there, but we've initiated coverage of the stock due to its strong financial metrics as well, but we'll continue to conduct due diligence on this stock just to ensure that we have conviction in the business, hence why it's currently just at a borderline star growth stock at the moment. Moving from mining services to retail, a stock that has garnered a lot of attention is Cettire. The code here is CTT. The company operates an online platform that sells luxury products at discounted prices, and the return on equity is impressive, with forecasts also displaying a strong earnings growth runway here.
It's an interesting stock, isn't it, Keen? It's quite polarized when you have a look at some of the analysts' research from the sell side and compare that with our own analyst, Jason Yin, who holds significant reservations on the stock because he does not believe that drop shippers like Cettire have sustainable business models. Now, drop shippers are a business model where the sellers don't actually own the inventory and have those products shipped by a third party when a sale is made. And I guess the best comparison point for people on the ASX would be to look to something like Temple & Webster. And as you can see with that particular stock, there's significant share price volatility and earnings volatility attached to these type of businesses.
Yes, volatile indeed, and those net profit margins look quite low as well. The problem with selling luxury goods is it's quite costly to have stringent checking processes in place to ensure products are genuine. And recently, there's been news that the company may not have paid their share of import duties and tax sold in Australia. And this, of course, has also led to additional volatility, with the stock down by more than 10% on that news.
Yeah, a lot going on here, Ken, and I think that was a news article from the AFR. And this information is a bit difficult to verify without any real tangible evidence. And our view here is that, when there's smoke, there can be some fire. So given the share price has done a lot of work to the upside, it's up to management now to win back investor sentiment and demonstrate that they've complied with all laws and paid relevant duties and taxes. This is an unfolding story, so we're happy to observe and sit on the sidelines for now.
Yeah, quite a bit of risk there, Matt. But looking at the week ahead, there are no Star Stocks results expected to report, but Star Income stock, Spark New Zealand, they are expected to go ex-dividend around the 21st of March, and the stock is currently on an unfranked dividend yield of around 5.7%. In Under the Microscope this week, we take a closer look at oil and gas company Karoon Energy. The code is KAR. For those who are unfamiliar with the story, Karoon's primary asset is located in Brazil, and they recently purchased a 30% stake in a couple of gas assets located in the US Gulf of Mexico. The company's incredible earnings per share increase over financial year 23 was driven by the enhancement of its Brazilian asset, which resulted in a 52% increase in annual production. And with production volumes expected to increase on the back of the recent US purchase, what has driven the negative earnings revisions over the past 3 months?
Yeah, pretty good question there, Ken. The company did provide a trading update in late January, which pointed to a temporary drop in its production volumes due to mechanical failure and some operational delays on a couple of their wells. So production guidance has been lowered by about 7%.
Right, thanks, Matt. I also noticed that the earnings quality was weak over the past period as well, but the company is undergoing a transition year, with management changing the financial year end from June to December, which they hope would better align with their overseas operations. The drop in earnings quality is more of a function of the annualization process and also normalization of significant items such as changes in cash flow hedges, transaction costs, and currency movements. Hence, we're not too concerned about this metric for now.
And members may have also observed that the company's return on invested capital in FY24 is at about 36%, which appears to be normalising to around that 40% range it achieved in FY23. Again, members need to be mindful that the financials in the interim periods are annualised, which could influence certain metrics such as ROIC over the full year. So furthermore, the company did raise some equity to purchase the US assets in late 2023. So this increase in equity would likely weigh on the return on invested capital for the full year.
Yeah, not to mention the oil price and expectations there as well. But Karoon's share price is trading at a discount to consensus share price target. But of course, with energy stocks, we need to be mindful that consensus prices are reliant on those long-term energy price assumptions, which will change with the underlying commodity price volatility. Also be careful here of relying on PE multiples for these type of companies, which tend to be low at the top of the commodity cycle as well.
And investors may be wondering how Karoon compares to a company such as Woodside Energy. And prior to its purchase of the US asset, Karoon was predominantly an oil producer, but now it operates both oil and gas operations. And Karoon remains a minnow at only producing 11 million barrels of oil equivalent produced versus Woodside's production of 190 million barrels of oil equivalent. As such, Karoon trades at a substantial discount to a company like Woodside.
Yeah, if members want exposure to an oil and gas sector and don't mind taking on a bit of that risk, then Karoon would be more suited given its production ramp up. On the other hand, though, if members want the safety of a larger cap with an ability to pay dividends, then Woodside is your bet. Woodside is currently on a forward gross dividend yield of around 8.4%. Following the takeover bid of Ultium from Japanese chipmaker and semiconductor supplier Renesas for a cash price of $68.50, members may be wondering firstly why the share price is trading at a discount to the offer price, and should they wait for the takeover to go through or take profits now?
Yeah, it's sort of the million-dollar question, isn't it, Kien? Look, the deal has been approved by both sets of directors of each company, and it's expected to close in the second half of 24, conditional on regulatory approval and a shareholder vote. And the other risk is that maybe Renesas actually renege on the proposed offer, but we believe that is highly unlikely given the fact that there is a 4.5% reverse break fee in that particular event. So given all these risks, it's not all that surprising, Kien, that the stock is trading at a slight discount to the actual offer price.
Yeah, that makes sense, Matt. Despite this, we do believe shareholders will vote in favour of the scheme due to the attractive offer price, which is around 30% higher than Ultium's all-time high price prior to the announcement. It's also significantly higher than the bid made by US engineering software giant Autodesk 3 years ago at roughly $40 per share. And for those who are wondering whether to take profits, well, this really depends on your personal situation. Taking profits does mean that you will forfeit the potential 5% upside, but allows you to raise cash to invest in other opportunities. So it also reduces your risk of this transaction not proceeding. Otherwise, you may choose to partially take profits and hedge your bets. The question you should really ask is, do you have enough cash on the sidelines to take advantage of opportunities later when volatility emerges?
Yeah, couldn't agree more with you on that one, Kien. And look, currently the fund, for those wondering, is maintaining its exposure in Ultium. But obviously, if the stock does move towards that offer price or closely resembles that offer price, then we'll certainly be considering taking profits on this one.
Yeah, but please read our commentary on these stocks if you would like to learn more, or feel free to attend our Lincoln Live webinar on Monday if you have further questions. That's all we have time for today. Thanks for your insights, Matt.
No, thanks for having me again, Kien.
Pleasure's all mine. And just a reminder about our masterclass event in April. There are only limited tickets available, so please make sure you reserve them as soon as possible. In the meantime, take care and have a happy, healthy, and prosperous week ahead.